If you want to go fast, go alone, but if you want to go far, go together. We've seen enough hard stuff.
Yep.
I've got to say, with all due respect, and I say this very politely, trust me, we've done far harder stuff in our lifetime.
Mm-hmm. Yeah, definitely.
I've got Damien Walker from the team. G'day, mate. How you doing?
Good, mate. How are you?
Sitting behind those numbers is the amount of experience and expertise that comes from a daily basis on what we do for a living.
It was try to find a way to help them. That's where you become a real problem solver from the start.
If I didn't kill, I didn't eat.
Correct,
So
yeah.
like,
Every deal had to work. We grew from hard work, like all our blood, sweat and tears into these deals, slowly at the start, and then something clicks. And suddenly, like you always say, the hunter becomes the hunted, and it suddenly switches.
Yeah. We'll have a look at everything. I'd very rarely think that we'd have a loan that we go, sorry mate, there's nothing we can do here.
No, never.
G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. We're coming to you live from our new headquarters. Again, if you follow our journey, you'll know that down here in Woonona is our new office, and we're kind of shooting here. I've got Damien Walker from the team. G'day mate, how you doing?
Good, mate. How are you?
Love having you on, mate. I know we get straight into the deep, murky waters of lending, so we're going to cover off a fair amount of turf. There's a couple of things that I really want to kick off. One is we're getting a lot of interest in our Property Accelerator group. Now, if you join a gym, it's great. And this is my own experience. Like you join a gym and you go do things on your own, all well and good. It comes down to a little bit of self-motivation and a little bit of discipline. But what's the saying? If you want to go fast, go alone. But if you want to go far, go together.
Yep.
And I think you've subscribed to that. We've been on the journey for a long, long time together. And the level of accountability, but also community that comes with being on a shared journey, I think is where becomes a really fun part of being a property investor. And that's what we do. So the second Wednesday of every month, we bring an online group. Look, guys, we don't have girls. We don't have a Facebook group. We don't have anything that comes with bells and whistles. All we do is bring a few investors together, pop the hood on a couple of questions. So last month, we had a financial planner join us. For the month of November, we've got the guys from H-Tag, Matty Jolick. He's jumping on, which I think is going to be a real crowd favorite.
I might join that one too.
I mean, you've been loving the stuff that's sitting under H-Tag.
Yeah, definitely.
They've got their own community as well, which I think is going to be invaluable for a lot of people that are really a little bit data-driven, or they want to do their own number crunching or suburb selection when it comes to maybe engaging a BA as well. So if that's something that interests you, jump across to our website. There's a little pop-up box that appears down the very bottom. Put Property Accelerator in there. Siobhan, my EA, will reach out, send you a link to join us on Wednesday. I believe it's the 12th of November, 7:30 Sydney time. We kick that off. It goes for about an hour. Love to see you online and come armed, prepped with some questions, thoughts, if you want to be part of that as well. So that's step one. Jamie, we're going to cover off a fair bit. And I think the first part to mention is that there's no false humility that comes with this, but we probably play a game where we don't go to brag about some of our achievements.
Yeah, definitely.
And accolades. I think, mate, it comes and it goes. But for you and I think something that I'm particularly proud of seeing you and where you've got to is recently our industry magazine called The Advisor. Both magazines, Mortgage Professional Australia and The Advisor, will publish a top 100 list. Now, we've both been featured in the top 100. This is purely based off the volume of loans that we do. So typically a lot of brokers use a bit of like an ego flex.
Yeah,
we don't. We just know it comes and goes.
Yeah. Good publicity.
Yeah. Point of difference.
Yeah,
but I think what happens is when, I guess, within our team, we go, right, you've been broking for a few years.
Yep.
And you got yourself to 71 out of 23,000 brokers. I've sat in that list. I checked it out, 18 in the list as well.
And that's your bet. That would be your best place, right?
Probably, yeah.
Yeah, definitely.
Yeah.
I think so. I think 30s before.
Yeah, okay.
I can't remember, but I think...
Mate, it's the same thing. I can't remember.
Yeah.
And I think that probably that's what it means. It doesn't mean that much to us that we get hung up on it. But what
I've just been saying to people 70s.
All it is we've seen enough hard stuff.
Yep.
We've seen a lot come across our desk that if anyone, when they reach out to us going, I think my situation's complex, I've got to say with all due respect, and I say this very politely, trust me, we've done far harder stuff in our lifetime.
Yeah, definitely.
I mean, let's talk about one thing, and this probably comes out, and a reason why I want to kind of preface this chat for Damien and I is very much to drill home experience and expertise. That's what the message is. So this award stuff is no flex. All it is saying, sitting behind those numbers is the amount of experience and expertise that comes from a daily basis on what we do for a living. That's what we want to share and impart with you as our listeners. So we've been interviewing a lot for team members to join us. And when we go to interview within our broking industry, one of the questions you'll ask is, how many lenders have you worked with in the last 12 months, whether that's for a broker assistant role or a team member in like a loan processing role? What's been your experiences?
It's been very shocking, especially when I can see some of the brokers that they've worked for. It's shocking because it's quite a small amount of lenders that people will use. So typically speaking, you'll hear the big four, and then maybe they'll normally have a non-bank lender.
Yeah.
So it'll be like, okay, I work with ANZ, blah, blah, blah. First Mac for SMSF.
Latrobe.
Yeah, and then like a
Go
Latrobe.
straight to Latrobe.
And then that's pretty much it. So
Or
like,
Liberty.
Or Liberty. So they're like 5 or 6 lenders.
Yeah.
And they'll have like, for SMSF is always, we go to First Mac.
That's if they do SMSF lending.
If they do it.
If they do it.
Yeah.
Mate, I'll tell you something. I interviewed someone the other day. We took them through what we do, resi, commercial. I was saying, listen, who do you use for SMSF? He's like, I've never done an SMSF loan before. I was like, you're nearly commanding a 6-figure income to join our strategy team, and you've never done an SMSF loan before. I reckon today we're probably pumping about 4 scenarios.
Oh, yeah.
Today, this morning on SMSFs. And I'm like, to me, brokers will talk a lot about how much they do, but the level of the depth and breadth of experience sometimes, I don't get carried away by it because I'm like, mate, literally lender usage in our industry, on average, it's about maybe 5 or 6.
Yeah, it should be published. And I was thinking like, because like
agree.
top 100, it's a volume-based game. And just because you write more doesn't mean you're better, right?
Yeah. That's why we see through the bullshit.
Yeah, just you've attracted more business or you've written whatever it is. Or 1 year you've aimed to write to get in. Some people just aim to get into the list for 1 year. So I don't really take too much. Top 100, fantastic. It doesn't really mean too much to me. I'd like to see, along with the top 100 list, because they do number of applications, which is very telling, average loan size, number of applications.
Yeah.
Some brokers are working extremely hard. Some brokers are writing really just big deals, a lot of them, but also number of lenders used. I think it would be such a good metric because we now have to follow best interest duty bid. You know, we have to look after the client's best interest. If you're only using 6 lenders a year, you are not following the client's best interests.
Mate, I mean, for some of the stuff that I looked at this the other day, actually. It was because leading up to that interview, in the last 12 months, I've used 22 banks.
20 for me.
20.
Yeah, 20, definitely. Yeah, 20.
That's insane. So everyone goes, I've got a big panel at 30 banks, but you're using 6.
Yes.
Bro, reality check, right? When you and I go, we're using 20 or 22 out of 30.
Yep.
That's a third, 2/3. We're using 66% of our lenders. The other ones, I'd say, are very niched, like they're very particular lenders, and nothing wrong with them. Probably the rates just aren't on parity. We could find a solution with a different lender.
Yeah, definitely.
But I'd say that if you're trying to see where I'm trying to get at, the level of depth and experience of what we've got here under our roof, I mean, if we start going through, we're seeing overseas income, we're seeing massive property portfolios, we're seeing commercial, we're seeing self-managed super funds, self-employed that sit within there as well. No mortgage insurance for professionals. Mate,
trust companies, mismatch of ownership and loans. Yeah. The list goes on.
Okay, it does
so
go
much
on.
complexity. There's a home for it. That's why you come to a broker. We've got 40 lenders that we can access.
Yeah.
There's got to be if you've got income and there's serviceability, there's got to be a policy for you somewhere.
Yeah. And I think the other part now is as brokers, market share of mortgage brokers. So this is how many loans mortgage brokers have written comparative to banks. We now sit at close to like 75, probably even nearing 80%.
Yeah, I think it's near 80, yeah.
So now what happens is, and you picked this up years ago, which is now we're not competing against banks, we're competing against other brokers. And it's probably where I'd say yours and my line share deals come from.
Yep.
Is I've spoken to a broker, but I don't think they're actually understanding what I'm trying to do here. They lack the depth of experience that I'm looking for. They're not strategic enough, or probably the worst one that probably grates our gears is they don't get back to me.
They don't get back to me, or when they're too conservative. He doesn't think I should borrow that much.
That's crazy.
Like the bank is willing to lend you that, But the broker's saying you
The
can't
broker's a credit
afford it.
manager.
Yeah. Yeah, know your place a little bit.
Yeah.
Yeah, I
You're
hear
here to
that
do
all
a
the time.
deal, or you're here to kind of curtail a client's living expenses and go through if they should be buying a property. Well, I had one broker, I think I've mentioned this in the podcast, one broker said to a client, why are you paying a buyer's agent?
Yeah, right.
Crazy stuff like that. So we never like to fire shots. I think there's more than enough. We have abundance mentality, so there's more than enough deals to go around for everyone. There's enough food for everyone to eat. But I also think when there's a little bit of hunger in the belly, you and I going, how do we solve more problems? We solve bigger problems. Yes, we get paid more.
Mm-hmm.
We're paid for solving problems and level of complexity as well. But that in turn then becomes the ethos for our team that we go, hey, mate, we're here as mortgage problem solvers. See a problem, solve a problem.
Definitely. Yeah.
Cool. Mate, as reflect, and again, going on the awards, I mean, we're really lucky this year, top mortgage employer as well within the industry. Again, this is stuff that we don't have a social media person, so we'll probably get this stuff under wraps.
But we are looking for
Good point, actually. We are looking for a marketing person. Rachel, our last marketing manager, went on mat leave with her second. We have a vacant seat here. So if you know someone that's a gun, marketing coordinator, marketing assistant, social media, anyone that's looking to sink their teeth into marketing, the podcast is something, the socials is something, the community that we're building around Property Accelerator is something else there as well. Mate, drop us an email, get in touch with us. We'd love to have a chat. Good point. As I reflect back, and this is probably you and I, where we talk nearly about 10 years being in Atelier Wealth,
correct,
right?
yeah.
And that decade of like slow growth, and then it's probably like really compounded for us as well. I think that's the journey that people haven't seen as well. And I think I'd love for you to just share that, because I mean, the start of it was the three of us, small office on Hunter Street, sitting on Australia Square for lunch. And then now do you reflect back and go, geez, man, I blinked and a lot happened, but there's also some really testing and trying times in there as well.
Definitely. I was thinking about this the other day. Someone asked me, like, what makes you different from other, like, why did you make the top 100 over the other brokers? And like, sure, it's a volume metric, but behind the scene, there's also a lot of hard work that goes into it. And for us, I mean, when we all started, you started first with Mortgage Choice and then transitioned to Atelier Wealth, but you were new to industry with Mortgage Choice and only there for about 18 months. And then Burnout and I joined, and we were completely new to industry to the point where I hadn't written an email for like 5 years prior to joining, right?
Yeah, crazy.
So I had to learn how to write an email. Well, I knew how to write, but the format of how to write one. And we just self-taught our way through it. Like you were out there hunting for leads, and people don't see this part of it, right, at this stage of the journey. But you were up at 6 a.m. every morning at, what's the park called in Sydney?
B&I.
At B&I, 6 a.m. every morning, driving up from Thirroul, still doing it with the baby, with Sienna. And Bernadette was obviously looking after her, and you'd get up and still go up there. Getting every lead. Every lead meant we had to convert.
Yeah.
Right?
Yeah.
I remember that being like the first couple of years was every lead was, it wasn't we can't help you. It was try to find a way to help them.
Yeah.
And I think that's when you cut your teeth in that environment, that's where you become a real problem solver from the start. There's no...
The deal comes in, it's like, it's gold. Like
you're sitting there going, and you're already like, if we write this, here's the upfront. Right? Like you're thinking of deals in like upfront commissions and going, okay, this can keep us going. This is going to be what we need. I know you had that mentality. I was probably a bit too young and a bit too naive, but
I mean, if I didn't kill, I didn't eat.
Correct.
Right?
Yeah.
Point, like cash flow wise.
Yeah, definitely. And looking back now, like where I'm at with my business, I can see that's why you were that way. Like you had to make things work. Every deal had to work. So yeah, I mean, the first couple of years, I mean, it's funny looking back at the time, I thought I had the hardest job, but we were only doing like 60 mil a year. At the time, it felt like we were flat out.
Yeah.
But now we're doing like 60 mil a month as a company, right? So it's crazy how things change. But as you grow, if you keep putting in the hard work, you'll get the rewards. And I think that's what a lot of people probably don't see is that, we started from very humble beginnings, very small customer base. we grew from hard work, like all our blood, sweat, and tears into these deals, trying to find a solution for every client that came in the door.
And that's an ethos that still today,
Well, that's
that
what it is.
has not changed.
It has not changed one bit, and that's what I mean. We cut our teeth with that, and it never changed. It was once you realize, hey, there are problems that can be solved here. Like, and again, even in the early days, we got most of our deals from other brokers, like who couldn't do it.
Yeah.
Oh, I can't do it. Too hard basket. All right, well, let me call Pepper Money and find out what their policy is here. And then you start to unravel little things around these lenders and what policies they have and what appetites they have. And suddenly you go, oh, wow, there's a world of like opportunity here. And yeah, that ethos has not changed one bit. So we've just been growing and growing and growing. Yeah, you're right, slowly at the start. And then something clicks.
Yeah.
I think it's your existing clients are a certain number, your reputation's out there. And suddenly, like you always say, the hunter becomes the hunted, and it suddenly switches.
Yeah.
And now we're in a position where we're not picking or choosing clients. I still help anybody.
Yeah.
I don't care who it is.
Same.
I got a deal like this morning with a client whose dad wants a loan. He's retired, like 120K loan.
Yeah.
I was like, yeah, I'll see what I can do, because they're fun ones now. Like
That's a challenge.
Who's going to accept age pension?
Yeah. Reverse mortgage or something.
Who's going to do a reverse mortgage?
Yeah.
It's a 120K loan. It's not much money.
But we've never looked at and this is again what I want to reiterate is, we've never looked at it going, that's a 120K loan, I should be trying to work on a $1.2 million loan.
No, never.
The loan's the loan, the deal's the deal, it's client to client, for example.
Correct.
And we've never judged the loan, because here's the thing, a $1.2 million loan or a 120K loan, still the same effort.
Yeah.
Still the same documents we need, still the same strategy we got to provide, still the same data entry.
Compliance, everything.
Great.
Yeah.
So the deal size, there's not a correlation for effort and reward. It just happens to be a larger loan limit, for example.
Yep.
But yeah, and sometimes the smaller loan clients can go and become, great referrers, leave a great Google review, open doors to their accountant, for example. So you never know where those deals take us. And I think that's the part where we said we're never going to get too big for our boots or become complacent that we can just suddenly go, no, we're not going to take that on because it's not a deal for us. We'll have a look at everything. I'd very rarely think that we'd have a loan that would go, sorry, mate, there's nothing we can do here.
No, never.
And I think that's the part for us where I'm still proud of that as an ethos and values in the team, where it's like, turn over every single stone, show me how we've got there, and then we'll come in over the top sometimes and go, but what about that? And that trained eye sometimes is where we can see our experience show up as well.
Yeah, and it's a good point, and it's probably like for any brokers, any business owners really, like listening, you never know where your next lead's going to come from. But most of the time when you're starting out, it's from existing clients.
Yeah.
So the more clients you help, the more chance you have of referrals.
Correct.
So in those early days, yeah, every client was maybe an opportunity to write a loan. Every client was also an opportunity to get another client.
Yeah.
Right? So yeah, I don't turn down anybody.
Yeah.
Like I don't do asset finance.
Yes, big ups, thank you.
We don't do it. Out. I'm not good at it. I don't know.
We're not good at it. I think also as a values-based business, we don't do it because we don't finance depreciating liabilities.
Yeah.
We finance income-producing assets.
Correct.
Now, I've got to tell you, I think we've said this before on the potty, asset finance would get us an awesome source of revenue.
It's quick, so you get the deal in.
You get paid quicker than a loan. Essentially, there's less work involved than a loan.
Yeah.
But I got to tell you, ethically, we don't do it, and this is not high horse. This is just values. We put our money where our mouth is going, but we don't finance cars ourselves. Well, I want to finance property portfolios. Why would I go and finance something that loses value? I want to finance something that increases in value and gives me an income stream. Yeah. Buy the cars in cash, for example. And if you can't afford it, then don't buy it. Unless you're self-employed.
Correct. Yeah. Business.
Unless you're self-employed and then you have something. But the amount of times that the car loans, car leases reduce people's borrowing capacity, but they're sitting here scraping the barrel waiting for the RBA to cut rates. I'm like, dude, get rid of the car loan. There's your borrowing capacity. There's your deposit to go ahead for the next investment property. Play on. Yeah,
definitely. Yeah.
One thing that I look back, and I'm glad you reflected on it, because that's something that I was having a chat to a mate about the other night. He's like, mate, bloody, I was 18 or something. He's like, you'd taken that. I was like, mate, that number will come and go. Next year I'll be, who cares what number? So I think we don't get attached to the number. But what I do think is the constants that have been there is communication. even now, there's very rarely emails that don't get responded to within 24/48 hours. Calls get responded to. I've said it before, in 2025, to have communication as a point of difference in mortgage broking blows my mind. But that's something that wins us a lot of trust, which then wins us a lot of business.
Correct. I mean, going back to early stages of the business, like Aaron, you were big on, what was it? If you can track your pizza from the oven to your home, why don't you know where your loan applications are to?
I'm glad you remember that.
Oh, yeah, I remember that very clearly because it made sense to me. I was like, because at the time I was like 25 ordering a lot of pizzas, and I remember I'd be sitting there at home, like you could really see it's in the oven. They tell you
real time.
it's getting cut. It's on the way. And I was like, yeah, fair enough, actually. Like, people shouldn't be chasing you up for updates.
Yeah.
You know, if you've got a loan application in the system, you should know where it's up to, especially when you're hiring someone, but like using a broker to facilitate that transaction. And it is pizza, it's emotional because you're hungry, but property,
it's low involvement.
Property, it's that a lot of higher emotions because, it means a lot. It's an opportunity to maybe, save money or build wealth or whatever it might be. So, big on communication. We always have been. Again, one of those early core values was to make sure we're communicating with our clients in a timely manner. And when they're contacting us, and it happens, like, we're not perfect, but we want to make sure we're on the front foot in that respect.
And some clients are naturally more nervous. They'll reach out. They know they're nervous Nellies. And like, look, guys, we know we're reaching out and we know you got it under control, but we just want to know, like, we're happy to give you some peace of mind and some reassurance. But I think for you and I, and we tell this to our team all the time, is no one ever said, God, I hear from my mortgage broker too much. They always say the exact opposite. And I think that's something that we try to really embody, even as we continue to scale in the business. If we're trying to keep those core values intact, for example, that's something that we need to impart to the team and go, you and I still, with how many emails we'll get, we still respond to them, or the calls that we get, for example. And we build a few buffers with assistants or other team members, but literally we're always a phone call away.
Correct.
Right. Yeah, so we're never uncontactable or not reachable or too big for our own boots. So that's something that, again, this is not us chest beating for business. It's more just to say, look, there's people that have been reaching out. So many listeners have been reaching out, listening to the podcast for some time. This for me is a chance to really peel back the layers in our business, show you what we're all about, be open and transparent with how we run this business. Because ultimately, if you're entrusting your broker and there's a huge transfer of trust, you want to know what they do on a day-to-day basis that separates them as the top 100 to the other 22,900 brokers that are in the country.
Yeah, definitely.
Yeah. The other one I think for you and I and our whole team is our level of personal growth.
Yep.
I see the team and like they're always talking about property, for example, not in an obsessive way, but just going, what are these people doing? How are they buying? And you can start to see the dots we're connecting with a lot of team members around. Most of the team have bought property as well. You've been there, so we've got a huge amount of empathy for what clients go through. So not only experience that comes through, but empathy, and we get it. But I think you've also, when you and I catch up, you've got your own coach, like training as well. So I feel like where that investment has gone to yourself, you're probably getting that 3x in terms of its value back to you. Yeah,
definitely. Personal growth in this industry as a broker, if you don't look after yourself, you'll burn out. And we've all burnt out before.
Oh, mate,
right?
People know that. I probably took a few good months off there for some time off the phones, and
I
think you got to have that level of self-awareness to go, I think I'm redlining, and it's probably a time for me to step aside. That probably gave you the chance to step up at that point, right?
Definitely, it was my chance. Yeah. So personal growth is definitely something that it's encouraged here, and it's nearly a necessity as a broker. You need to have that time to, I guess, re-energize. You got to be fit. You got to be healthy. It's like you got to be like in fighting shape.
You do
when you're acting like when you're dealing with this many loans and this many clients. And it's more for me personally. The reason why I started really in the last couple of years investing into myself is because I want to give, and it sounds like cliche, but giving more to my clients. There's sometimes when I'm burnt out and I'm just not even like giving what I know I can to somebody.
Mm.
And I just feel like I'm actually, yeah, you're not giving it your all and you feel bad about it. You're like,
And I think there's probably been times where maybe a client can tell that we're not either fully present
yep,
or we're a little bit checked out, for example. And that probably happens sometimes when, you know, your red line just to get to a holiday. It's that last week before
Yeah,
you and I get
definitely.
busy, the last week before anyone gets busy before that last week before a holiday.
Yeah.
I think you've even had some awareness that you almost close your book off before, you close your
Correct.
diary off before you go away on a break going, well, I'm not going to take any new clients because you're headed away. I think it's something that I've learned from you on that front as well. But it's like you're taking a holiday for a reason because you're bloody maxed out and you don't want to be limping to the finish line, which is pretty much a lot of the Christmases for us becomes that because everyone's going so hard and trying to settle before Christmas.
Yep.
That you and I have just gone, mate, absolutely all in. And then we've had the Christmas break and we're bang, first week back in January, right back into the swing of things.
Correct. With that.
Whereas I think we've got better at having these times out of the business, out of work, switch off the computer, tools down. I'm recharging the batteries and then come back revved, ready to go.
Yeah, definitely. Yeah, I've got a coach now for like account. It's like talking to Aaron's like the property group. My coach is just for accountability. I know what to do in the gym. I know what to eat. I know what not to eat. You know, when you're eating a chocolate bar, you're like, probably shouldn't do this every day. But to have someone to be accountable to, and yes, you've got your partners and your friends, but sometimes it needs to be someone independent. Someone
their job is not really to push you to that next level.
No, and if you use your partner, and I've tried to use my partner before in the past, they get tired of it as well. Like that's not
their job.
That's not their job.
Yeah.
Their job is to be there for you and support you and love you and all that jazz, and even your friends or your family. But if you get like someone who you can just be open and honest with, accountable to, and they can push you and cut through the BS.
Yeah.
And my coach, if he's listening, would know like I'm always like I'm too busy. I missed a session. And he goes, you chose to miss the session.
Nice
it's
one.
your choice. He said that to me the other week and I was like, fair enough. I pretty much was like, the external factors why I didn't go to the gym. He goes, you chose not to go to the gym. Fair enough. So yeah, I think investing in yourself, it pays dividends.
Yeah. That's what
in the long run.
Health is wealth. And I think we've probably done a lot of work internally as a team, like really defining those wealth parameters. Good family, great friend network, great culture, great team, eating well, be able to sleep well. I mean, I think you normally you're missing a Whoop today, but normally we're tracking sleep, for example.
Yep.
And they're probably our lead indicators to go, hey, look, we're probably giving this a nudge. We need some downtime. And there'll be times where the team know they've got to pick me up a little bit because they know I'm running on empty. And there's teams that I pick it up with them and go, mate, you need to probably take some annual leave as well because we need to have each other's back. And I think to your point there, that's what the accelerator was really built for, which is building. I don't care about the quantity. I really care about the quality of people that come along and go, I'm happy to invest an hour of my time. We don't, we charge a few people for it. For example, our clients don't get charged, but people that want to come in, it's going, well, here's a place where you can sharpen the sword a little bit, come in, be around some top tier investors, even people that are starting out, but just going, mate, I want to kick some goals. I want to see other people winning in this game as well. Mate, coming into the market, and this is probably where, you play in a few other different segments. So you do a lot with first home buyers, for example, where typically I don't. But it's very rare that I see every single segment on fire. So I look at first home buyers, I look at upgraders, I look at property investors, I look at self-managed super fund, I look at residential and commercial, for example. And I can say every single one of those segments is gone bonkers at the moment. Typically, you've either got it's really first home buyer market softened a little bit. It's a great time for first home buyers to get in, or investors are really bullish, for example, because lending might have tightened up, but they're able to find ways that, to think about non-bank lenders or other ways to get in. Or there'll be, a couple of times where we think about this is a good time to upgrade, for example, and we do a bit of a bridging. But I'd say we are doing all of the above at the moment. It's crazy.
Yeah, exactly. And I've got some theories around like why.
Tell me, it's exactly why I've got you here.
Oh, cool. Yeah, so it all started with the RBA. Well, no, the RBA will obviously cut rates this year, right?
Yeah.
Feb, May, August. Was there 3?
I think so.
Anyway.
That's how little we kind of track these things. It's happening, mate.
Yeah, it's happening.
Yeah.
Adjust the rates by 0.25. So RBA's cutting rates, that's good. Now people can borrow more, right? That's the start of it, I guess. But really, people were already in 2024 assuming they would cut rates. So it helped with borrowing. It didn't really do too much to, I guess, the demand, or I guess people were still looking to buy.
There wasn't an urgency.
It wasn't urgency. That's right. There was no urgency. There was an increase in borrowing, but it wasn't too urgent. Certain hotspots like Townsville, urgency was in that sort of market. But then the government brought forward the first home guarantee scheme. It was supposed to kick off on the 1st of Jan 2026. I don't know why, they just announced it. 1st of October 2025. That really lit a fire under everybody. Investors, they wanted to get in before it started because they were like, this is going to have an increase in prices. It's going to have obviously a positive impact on prices. First home buyers, of course, we already had the people who were in the scheme, but now it opened up the scheme to every first home buyer.
Correct.
So no income cap, price caps went up, unlimited spots, bang.
Crazy.
Everybody
5% in the market, no LMI.
And you got to think of the percentage of people under 35 who are first home buyer. I don't know the percentage, but you'd imagine it'd be high, right? So suddenly, nearly everyone between 18 and 35, if they had the deposit, could go and buy a property.
Right.
So that really lit a fire under everybody. And so that's the first home buyers, investors. Okay, that makes sense. Upgraders. Now, I'm sitting in this market where my property is worth under 1.5 million. Now, that's the new price cap for Sydney. What's happened in that sub 1.5 market is that every property, sub 1.5 has gone up in value by about 100 grand in the last month. And I've tracked it. So many areas have that increased in value because first home buyers are now competing. We've had rate cuts as well. So people who are sub 1.5 already in the market have just seen their equity increase by that much. Honestly, it's about 100 grand.
Yeah, I can imagine.
And they're going, okay, cool. Now it's time to upgrade. I've just had a free lift up. The properties above 1.5 haven't gone up by that much in that quick of a time. So
they've lost a segment to sell to.
Yeah,
right? Yeah,
exactly.
There's buyers of that market.
So that's gone up, and now upgraders are now going, cool, I've got 100 grand. I'll sell and upgrade into the market above 1.5.
So that PGT free.
Exactly. So we've got the upgraders now moving in.
And we know this because we're doing so many bridging loans at the moment.
Yeah. I don't know what's scared. People are just ready to move. And then you've got your self-managed super funds, which is still sort of I guess a after effect of the rate hikes. It's just now widespread. The rate hikes drove people to the SMSF because their borrowing went away and they wanted to keep buying. And now so many people have an SMSF. Everyone's looking to use one. Now everyone's talking about it at a barbecue. Do you have an SMSF? How much do you have in your super? You can buy a house.
Well, think about, then we get a lender that comes out with a 90% no LMI.
You don't really need that much.
So you can get into the market with 10%, no mortgage insurance. So if you think about it, 150 grand, I've worked it out, probably buying is probably around 600 grand.
Yeah.
That's crazy.
I think the average super balance, I read it the other day, is 180,000.
Right.
So that's 20% of a 900K property. 180.
Split that and you buy two properties.
Split it into two. You're definitely buying a property with that if you've got serviceability from your employer's contributions.
Correct.
So I think the amount of SMSFs that were created, that's just become another widespread vehicle, which has driven that sector and continue to drive that sector.
Yeah. I also think what happens with SMSFs is if you and I have investment properties out of super, in our individual names or whatever in trust, and they're all negative, right?
Yep.
We're not seeing yields that's sitting at 6.6% or thereabouts. But because I'm regularly topping up my super every pay cycle, that negative cash flow is just getting sucked up into that out of that kind of loan balance, so the offset account balance or whatever I've got in super, and I'm topping it up. So I'm not feeling the negative effect of that, having that property being out of pocket.
Correct. Yeah. Cash flow.
So cash flow wise, I'm it's not really costing me anything. So they're not feeling the pain. So well, there's no downside to buying through a self-managed super fund. I'm buying both asset.
Yeah. Yeah.
Cash flow wise, it's taking care of itself. So I'm not worried about the negative side or plug in the difference in repayments versus rental income.
Yep.
And the market's on fire. So immediately, if they're buying something, not that we're pulling equity, but they know that property's increasing in value
with leverage, right?
Correct.
Yeah, exactly. I always tell people come up with the SMSF with the property strategy. Okay, we'll get something with a good rental yield, so it pays itself off. That's a good strategy. It's also fine just to buy a property that's probably hemorrhaging a lot of money, because the balance or the difference is coming from employer contributions, which you're not feeling if you're PAYG.
Yeah.
And if that is hemorrhaging money within a big growth cycle,
But you can just sell it after a little bit of time.
sell it after a little bit of time. It's a low tax
You would never
environment.
save that money in your super.
No, and then you could then go split it again. And you go, okay, sell it. You just increase your deposits and financial advice. This is what we see people doing
Constantly.
a lot of the time now, where now you've got a larger deposit, and now maybe you do a more diversified option where you then go, half that deposit goes back into a property with a bit of leverage, the other half goes into the market. And yes, seek financial advice when you're dealing with your super especially. But there's definitely strategies out there that I think are becoming more mainstream. That probably weren't. I think an SMSF, when we first started, I wouldn't have an idea of who would have had one.
Well, one, you needed a statement of advice. So you had to see a financial planner. Remember that we had to get an
Yes, yeah.
So you had to see a financial planner. The planners their licenses wouldn't let them sign off a balance of 250K.
That's still what I hear. People are like, oh, the accountant, or you said don't set it up.
Those are dinosaurs that are giving that advice.
Yeah.
So if you're getting that advice, you need
dinosaurs.
If you're getting advice, you need 250K super balance. You got a dinosaur giving you advice. We're seeing clients get in with 120K, and
I know, yeah.
And so when you talk about the eagerness of our rent investors, our sub 35-year-old clients, a low SMSF balance is now not a hindrance to get in. They're able to get in sub 500, 600, for example. 10% deposit, no LMI. Who cares about the rate because it's self-managed super fund? Cash flow will eventually wash its face if you really need it to. Otherwise, the next step is there's a major, I won't say one of the big four, but probably one of the big 6 or 7 lenders is now announcing they're going out with a self-managed super fund product.
Oh, correct, yeah.
And so for me, I'm like, this is just going to open the door that when you've got like a challenger bank coming into the picture, and this will be revealed in time. I'm not sure if we're going to announce it yet publicly, but when you see one of these banks come in, and it's a household name,
it's exciting.
And like the majors and other lenders have not played in this space for a long time. So all it takes is one of these banks to come in. You'll get another lender come in. They're going, mate, why are we back in this space as well?
Yeah,
it'll open up more competition,
big time,
which is great. And I think the other part that I see a lot of as well is the move into commercial through self-managed super funds as well. Yeah,
which makes sense. Like if you're a business owner, that's traditionally where we'd see it.
That's great.
Like all the time, business owner
paying massive rent.
Yeah, you can go and buy it.
Yeah,
you can still rent it back to yourself, unlike when it's a residential property, it's got to be at arm's length. But that's traditionally what we see now. It's not just like your owner occupiers, it's investors.
Yeah, I mean, we'll do two strategies for a client that goes out. Strategy 1 is here's your residential out of super. Email 2 is here's your SMSF strategy.
Yeah.
And it's like, bang, and the clients are going, whoa, I didn't realize I could do all this. And like,
correct.
That doesn't stop, but usually we can go purchase, hit a wall, go for an SMSF, come back, equity strip on the properties out of super, go again. And it's become this like accelerator for people that have traditionally been stuck to now go, hang on, mate, you're telling me I can keep buying? I'm like, hell yeah, let's keep going.
Yeah, definitely.
I want to go back because you and I probably see a lot of clients that have gone on to do some amazing things.
Yep.
And then you see clients that have come out of the woodwork years later that if they'd taken some action, mate, they'd be leapfrog. They would have had a different portfolio as well. So I want to touch on, what have you seen that top tier clients do? And the flip side to that is, what have you seen poor performing clients do? And again, this is said with no judgment. This is just purely an experience share from our perspective.
Definitely. You mentioned it, it's inaction.
Yeah, okay.
So people who don't act, they might overthink it. Whether it's getting your first property, your first investment property, whatever it might be. I think not acting when you can.
Yep.
Everybody regrets it.
Yeah, cool.
Hindsight's 20/20. You can look back and say, I should have done that. I should have bought then. I should have bought then. So people
with that regret also comes like, that's it, I've missed the market.
Oh, big time. Yeah, I've missed the market.
Too late.
It's already
Like
gone
Perth
up.
would be a really good example.
It's already gone up 20%.
People
or
are like, geez, man, I
40%.
should have got into Perth years ago, and now that ship has sailed. It's like, actually, man, you could find something of quality. You just may not be buying 20 minutes in a Perth ring, for example.
Correct. Yep. So, yeah, definitely inaction, just sitting on the sidelines. And yes, I've missed the market. I had that mentality. I think it was like, I should have bought 5 years ago. I should have bought that market then. But then I had this realization, would an 18-year-old sit there and go, I should have bought 10 years ago? Everyone's just going to buy when they can buy.
Yeah.
And if you can have that mentality to say, now's the right time for me, because fundamentally I've got the cash spare to go into it. I believe in the areas. I believe that, vacancy rates are low if it's going to be an investment. So you're going to have, relatively strong rental growth, or supply is going to be down for a little bit. So you're going to have some capital growth, or if it's your family home, it's the right area. We want to take on the risk of, going from renting to home owning with the increased responsibility of debt, but believing that we can repay it and that we're going to make a home out of this. Having that fundamentally thinking about why you're doing it and just acting on it, trying to get rid of the noise. And the noise is mainly other people. You shouldn't do this. You shouldn't do that. It's already gone. It's already done.
I've written it down. Parents.
Parents. Parents definitely. Don't, God bless our parents. But that sort of, the game has changed.
Their frame of reference, when they go, and I can say this with love because your parents are my in-laws.
Yeah.
And so even when you were looking, they were like, geez, over $1 million is a lot of money. I was like, with all due respect, man, this is entry level into the market. This is what it takes.
Yeah.
And that took a big paradigm shift to go, that's how much the market's moved from when they bought to what it takes the next generation to now get into the market.
And it's even harder, like going to experience share my parents, because they're in Nowra, I'm buying in Sydney.
Yeah.
So $1 million was like 2 bedrooms. $1 million was on an acre.
Well, I don't know. $1 million there versus $1 million in Sydney, comparatively, you could buy down here, you could have a big.
Well, this is it. Yeah. You have a pool.
Why do you want to buy a small 2-bedder in Sydney for? It's like, well, hang on, that's where I'm based.
That's the life. That's the lifestyle I want. So it becomes even harder with that. So you've got they bought 30 years ago. They don't understand the difference in markets as well. And if you let that noise get to you, you'll make a decision based on the noise and not what you actually want.
And it comes from a place of love. Don't get us wrong. It comes from as a parent myself, I can say the first thing you want to do is protect your child at all costs. So it comes from a place of love. Do you want to bite off more than you can chew financially, for example? And there's a part of it where you have to take that on and go, I know you mean well. There's a part of that going, but I can't absorb all that energy because it's not going to help me move forward, and you can't overlay your opinions as well. I think that probably gets a little bit convoluted if parents are then giving money because then they have a bit of a part of say, for example, it's a guarantor loan. So that adds a layer of complexity, but we've seen it where it's done very well. So it's not that it derails an entire journey as well, but just adds sometimes a layer there that creates a little bit of emotional energy that comes with it, right?
Definitely. So when we go back to, what separates maybe your poor performers versus, your people who are, you look at their portfolio and go, great, that's awesome. Whether it's one property or 10.
Yeah.
It's not, again, if top 100 was a volume-based metric, I don't think it's a very good way of assessing brokers, but it is what it is.
Correct.
Same with the number of properties in a portfolio. If you got 30 properties or one, who cares? How is that portfolio performing as a whole?
Yeah.
Right? So I think the top performing property investors or property owners, they're cutting out the noise and they're saying to themselves, I'm buying this for the right reasons. And they're not making a decision based on fear of missing out, which is what we're seeing right now in the market.
Dude,
I think
this is COVID. That's why I talk about every single segment being on fire, but every single market being on fire. So we'll do stuff.
Single market.
Queensland, Vic. I mean, Vic's working.
Definitely Eastern Seaboard. Eastern Seaboard is just.
So then we see Tassie become like this, it's woken up from its slumber as well. There's
Perth is still doing its thing.
Correct.
Yeah.
Still shooting the lights out there. Adelaide's still going great guns, softened a little bit, but still going great guns.
Northern
Queensland-
Territory, Darwin.
Darwin,
Darwin.
mate.
Imagine, like, I remember when they first started buying Darwin, and we were like, that can't be right.
Mate, every commentator's talking about.
I'm wrong. Yeah, I'll admit I was wrong.
Well, I mean, it's like
Yeah.
crazy when we were first
2017, 2018.
when we
yeah.
were first starting out. We literally, Damien, Bernie, and I looked at a property in Tassie in Sandy Bay. And we're like, this is bloody Tasmania. It's done nothing for 10 years. And then 2 years later, like, well, I think we missed the boat on that one.
Yeah, we did. Yeah, I remember.
Crazy.
Yeah, I remember.
And that's what a good buyer's agent will typically do, is get you out of that headspace of going, but here's what I think. Yeah, but what you think is very different to what
Correct.
their years of experience, their years of knowledge, their data, or the insights that they get, for example. I mean, like brokers talk, other BAs, I'm assuming, are talking, so they catch wind of where others are buying.
Yep.
And that can create somewhat of a ripple effect in certain corridors as well.
I think opinion-based purchasing versus like database purchasing is where you'll
Oh.
see a difference in
The
like,
death
outcome.
of opinion-based so is like these Facebook groups that I see for
What's it?
investors.
Oh yeah, yep. Oh yeah, I joined a few the other day. I don't know
God,
why.
I was like,
Un-
I would,
follow
yeah,
it.
I'd be very careful. It's like Facebook groups of mortgage brokers. You send
Yeah.
some questions in there, you're like, dude, you
These are
shouldn't
questions that
be,
you
you
see
shouldn't
some
be putting that in a
comments.
public
Yeah.
space as a mortgage broker. Just you're showing how little you know.
Mhm.
And the same thing I'd say for groupthink when it comes to property investors is
Yeah.
either looking for the amount of times, should I be buying here? And then everyone just weighs, mate, but how much is your deposit? How much is your borrowing capacity? How big is your portfolio? How looking to hold this for?
How much
Do you have
risk
owner
can you?
occ?
Yeah, how much risk can you take
Yeah.
on? What's your cash flow like?
Yeah, that's why I say those Facebook groups are property investors. It's built for a commercial interest. It's not built for outcomes.
Yeah, because let's be honest, like it's not rocket science. If you buy within a fairly established metro or regional hub, and you hold for long enough,
Yeah.
you'll make money.
The market's forgiving.
Very forgiving.
I'm just going to throw a dart. You throw a dart at a dartboard and you go to Newcastle.
Yep.
And you buy there in a really good location, Newcastle.
Yep.
Held it for 10 years, you do pretty well.
Yep. And this is like fun, like, and then, okay, but what property? Fundamentally, you buy a good property.
3 or
good
4
aspect.
better.
Yes, brick,
Flat-
whatever it might be.
North facing, flat block, decent sized dwelling. You take a 3 better, you can attach it, maybe you can build it to a 4 better.
Yep.
So you get to the sweet spot of Australian property, which is a 4-bed, 2-bath,
Yep.
for example.
Good schools.
700 square meter block.
Yeah.
Keep
Close
going.
to schools, close to shops.
Yeah.
You know.
You can't go too wrong. And if the property, there's something wrong with the property, then you got to do that due diligence to then go, okay, yeah, it might be an aging asset. So at some point, it's not a matter of if something goes wrong. It's a matter of when the hot water goes, the roof needs repairs, something happens with the garden, for example. Hey,
Yep.
just part and parcel of owning a property, just like it takes maintenance for you and I to keep ourselves in tip-top shape. The same repairs and maintenance goes into owning a property. Same repairs and maintenance goes into owning a vehicle as well. Part and parcel of being an owner of a particular object or an asset as well. Hey, going to your point earlier around mistakes that you see, I want to add to that as well. I'd say sitting above everything else, if you're a couple, is misalignment as a couple.
Yep.
And I'd say that I say that time and time again, which is I want to do this, they want to do that, and we can't seem to agree. And it feels like it's a win-lose outcome. And so then at that point it becomes a very much of a stalemate. That's like, well, someone's the handbrake, and I've spoken a lot about this in previous episodes as well. If one person is the handbrake, tools down, you now need to unpack what is either their money story, or what is their risk appetite / sleep at night factor, or what did they grow up with in terms of money and debt.
Yeah, definitely.
Yeah.
Or what are their competing long-term goals that they're not sharing?
Good one.
Yeah.
Good one. Yeah, because I see that come up time and time again, particularly when I'm talking to couples. There's so much opportunity. They know that they should be doing something. They just can't agree. And that's maybe where a really, really good team can come in around you and say, right, here's what your numbers will allow you to do. Why don't we just start with one property?
Yeah. I've actually got a very good example of this where we did a refi, we did a purchase, we did a refi and purchase. We did another cash out for another purchase, and we had a pre-approval ready to go as well. all sitting there ready to be funded, waiting for a property. The applicant, one of the applicants, I don't know, just turned around and suddenly said, "What's his money doing in my account as a cash out loan? 200K for the deposit, interest only, no repayments,
So
no
it's
interest,
fully offset. So
it's
there's no
fully
repayment.
offset.
Yeah.
It's like a line of credit ready to be used." She saw the loan amount, flipped out about the amount that was sitting there, and closed the loan. Yep. And then they didn't purchase. They were like, "We're not. I don't want no more debt." Just flipped. Something happened.
Crazy.
Now we're doing it again. So we've come back around 12 months later because of one of the markets that they're buying in has moved. They should do. It is a Victorian market. They were going to get in there, excuse me, like last year. Now it's going to be this year. We're going to do the exact same process again. Cash out, pre-approval. They've got the servicing. It's a really strong deal. But because there was just a misalignment with what they were doing and what they were buying, cold feet, and they've missed out on 12 months of gains.
That's great. And
they were about to get into the Victorian market before
bottomed out last year.
It was right at the bottom.
It bottomed out last year. Absolutely. It's on its way up. And I think that's why a lot of people now are getting that confidence. If anyone watches the property clock, it's gone from 6 o'clock. So the bottom of the market.
Oh, right.
Yep. It's gone from the bottom market. And you can start to see it's probably in some markets where it's into like 7, 8, 9. So it's starting to peak. There's no way it's reaching its peak, but it's on its way up. So if you're familiar with the property clock, you can do a quick Google and you can see where different markets are sitting. So if you look at the peak of the market, I don't know, would you say like Townsville or Brisbane would be up there, for example? And you say like there's those markets are peaking, or Perth could be somewhere like 10 o'clock and it's reaching its peak.
Yep.
That's the analogy that they put out. I'm pretty sure it's Heron Todd White that pushed that out as well.
That's a good analogy.
I should have a look at that.
Yeah.
You got to get across that.
So there you go. See, it's just one of those things where it's a misalignment in wants and needs. Ultimately, they did want to buy a property, but they just weren't communicating with each other about what they were going to do.
It's funny you talk about in the bank account as well. I think that's probably another big thing that brings people unstuck, which is having multiple banks and multiple loan splits. And it's like you're getting into the weeds of like, this is inconvenient banking.
Yeah.
I don't know about you. I don't know how many bucket accounts we've got, or I don't know how many loan splits we've got. Yes, I have a very.
I was going to say, you're lucky she's the one that controls it.
Lucky I've got the Ministry of Finance, aka Bernadette, that manages that. But even to Bernie's, like at some point she had to get like, I'm like, you got to get over this. It may not look pretty when you log into internet banking, but man, it's 2025. Just go in there and nickname the accounts, relabel the accounts into what it is. Okay, equity release against this property for this property, whatever it's going to be. And so you can use a spreadsheet, you can use the internet banking. If that's your bugbear to not invest, sorry, mate, you got to get over that. You've got to find a way to push through.
There is paperwork that you need to do.
So we've covered this. We've covered this type of turf, which is the inconvenient side of being a property investor, which is team signing documents, costs as well. But when properties increase and give you 10, 12, 15% return year on year, for example, with not having to do a lot of heavy lifting like a day job, mate, it's not a bad bang for buck as well. I just want to finish off with the DIY investor. And I've told this to my team. I've literally got a list of every single pre-approval. I'm like, show me who's using a buyer's agent and show me who's doing it themselves. There is literally a real-time, to me, what do you call those experiments? Test and control group.
Oh, yeah.
The ones that are doing it themselves have been pre-approved, and we're probably onto our 3rd pre-approval. It's killing us. I'm like, what do you? One, they're chasing the lowest rate. 2, they're redoing pre-approvals. I was like, mate, go and spend the 20 odd grand to get a BA. Nah, won't spend. But you're happy to miss out on 8 months worth of property growth to not spend the $20,000. It literally, I'm like, it blows my mind when I've seen other investors go. I think Nate has done one. Between buying, signing the contract, and settling, he already did a property report, and we were ready to pull out 50, 60 grand of equity before it even settled. It was crazy. I was like, you don't understand that because I don't know, is it stinginess? Is it a DIY mentality that you don't want to pay someone to go and buy a property for you?
It's a lot of money. Like, I understand 20 grand or whatever the BA fee might be is a lot of money. But when you correlate it to like missed growth it's why it's worth it. Whether it's off market,
Yeah.
where they get it under market, and that's obviously the dream. It's not always achievable, but it's always a dream. Or whether it's just getting you into a hot market early, so you're not sitting on the sidelines for 6 months, like a whole pre-approval essentially time frame, and in that 6 months, that property growing by 40 grand. You spend 20, you make 40, you net 20 in your hands, right?
And I think what happens is you see the loss of 20 grand come out, but you don't feel the $40,000 richer because it's equity, so it's paper.
Correct. Yeah.
And I absolutely get it. I'm trying to be as empathetic as possible, but I think what I'm also trying to be is an enabler. And part of what we do here, and part of why you're listening, is how do you enable yourself to continue to grow your portfolio? Sometimes our advice is, I think you need to get out of your own way. And I think we need to engage a professional here. So what I say sometimes can be a little bit direct, but it also can be said and misinterpreted, can be interpreted with, this is a little bit of spiciness that comes with love, to go, because we have literally the best seat in the house. We get to see every single investor's portfolio. We get to see where dozens of buyers agents are buying. We get to see how portfolios have gone on to succeed and how others have died when they had mad potential as well. Given they got nearly 10 years of experience, I want to bring this right back to the very top, which is, and this is probably why we sit with no ego said, probably at the top of our game in the broking industry, is because we see so much variety that comes across our desk, because we can enable deals to get done. And sitting behind those inverted commas deals are people that are actually growing and building really, really high quality portfolios. I'd very rarely see dogs in my like portfolios that didn't have equity that we can strip.
Yeah, definitely.
And I think that's where I really want to impart my experience to you as a listener, going, choose me, don't choose me, just choose a great broker. We don't really mind who you choose, but choose a great broker that's going to give you the outcomes that you're looking for. And if you can't, well, then you've got to vote with your feet.
Definitely. And to the BA piece as well, like a couple of tips for people. If you're buying in a hot market, it's going to be very hard to buy a property without a BA, without it taking a long time. I've got people looking in Townsville at the moment. It takes them so long because everyone knows Townsville has gone up in value.
Yeah.
So it's that property clock analogy.
Well, you've gone
we're at 11, 11:30.
You've
maybe we're at 12.
Yeah.
Yeah, maybe we're at 12. So everyone knows about it. Everyone's trying to get in. It's like gold at the moment. Don't know too much about.
Dude, I'm glad you said it.
Gold's going like this. I got clients going into gold.
Mentality is gold. Like literally,
Yeah.
it was. I want to make a quick buck. I want to make a very quick return on investment. I'm going to go straight into gold. And what happened? It plummeted to 12-year lows. Pumped and then dumped.
Yeah,
it's crazy.
So so if it's a hot market, honestly, just use a BA and stop stressing yourself out. Yeah, you can do it yourself in sort of cooler markets, but even then, if you don't know the area, it's probably better off using a BA anyway.
So coming to a cooler market would be like a slight risk.
Yeah.
Because you don't know how much is left before that property starts to increase.
Correct. You don't know how much longer it's going to be cool for.
Right.
So there's going to be...
So a good example of that would be Canberra.
Right now?
Right now.
Yeah.
Right? Take it.
Enough.
Hasn't done much. One of the poorest performing markets in the country.
After being one of the best during COVID.
Right.
Right.
And they go, all the markers say this market should increase. How long? You don't know. So you'd be early to the party. It's a bit like what we were talking about last year with Melbourne. You'll be early to the party.
But how long are you going to lose money? Because you're losing money on most properties and not see it grow. How long can you hold on for?
Yeah.
And you're still going to be losing the same amount of money, but it's easier when you can see the property going up in value.
Yeah.
It's harder when it's flatlining. Correct. It really is. So being early to markets is a blessing and a curse.
Yes. For the right investor, it's mad because they can just go, right, I'm not reliant on that equity to then go again.
Yep.
I don't need that to be a star right now.
Yep.
But I'm buying in. It's like people buying in Melbourne last year going,
fundamentally,
at some point it's going to turn. Yeah, at some point it's going to turn. But right now, that's where I'm going to, an early market. I'm happy to wait a while, be patient. But others that really need that, I need that equity strip to go again. That's where they're coming into hotter markets, and you can't bag a bargain in those warmer / hotter markets as well.
Correct.
You got to be willing to pay close to market value, probably even above market, to secure the deal. Because once those properties start to increase in value, the yields start to drop back a little bit because the price points here rents won't keep up as linear. So they're going to start to flatline. So the yields will then flatline at some point as well. So again, this is our experience share. If some of the stuff that was said sounds like gibberish, let us walk you through that. And it means that, hey, look, you might need to hear this or repeat it, listen to it a few times back to let it sink in. But I want to finish there on that note to say, look, 1, Property Accelerator, open for business. Drop us your details. 2, we are on the hunt for a marketing manager. So if you know anyone, you are someone, reach out to us. 3, I want to reemphasize, the fact that when we speak about being top 100 brokers, it's only possible off the back of having an incredible team that literally sit here behind us to make what we do possible as well. So that's a massive team effort, and we couldn't get there without mad clients to service either. So we can be great brokers, but until people trust us, that becomes irrelevant. So we've got an amazing level of clients that have come to us and trusted us to get it to that level. But I know you're hungry, I know I'm hungry, and whatever the number is, I'm sure next year at some point, we'll just go to the next level, not because we want some type of award seal, but we just go personally, we always want to be growing.
Definitely. Well, it's like helping our clients.
Yeah. And that's the whole point of growth. It's like, hey, mate, we're growing. They're going to keep up. Our growth becomes their growth. Their growth becomes our growth. And it's such a symbiotic relationship that we have.
Correct.
That it's a win-win all around. And I want to say thank you very much for investing your time, your energy into this podcast and learning. If this has resonated with you or you want to chat about this with your partner, share the episode with them. Bring them on the journey, as I always say. And let's create that ripple effect to get bigger and better. Thanks very much. We'll talk to you next time.